Good morning, everyone.
Good morning.
I really am happy to be here to talk with my realtor friends and really do nothing more than just help broaden the educational perspective of the qualified mortgage, the Dodd-Frank Act, and the impact that it's going to have on consumers, and more importantly, our ability to go out there and buy and sell houses and my ability to finance those houses. So you guys look pretty bright-eyed and bushy-tailed to start talking about this. This is a qualified mortgage. And I might actually just be the only person in San Antonio to read all 1,100 plus pages of the qualified mortgage. And let me tell you, it is not fun. If anyone is ever having trouble sleeping, I advise you to try picking this up and reading about the qualified mortgage, because it will cure any insomnia that you have. So what is, well, I guess let me get started first by saying this presentation, the opinions viewed and expressed here today are that of John Hudson, and only John Hudson, and not that of Premier Nationwide Lending or NAMB, the Association of Mortgage Professionals. So there. And I really, I try not to get too opinionated with any of this stuff. I do like to say that, what we're facing here is not a Republican issue, it's not a Democrat issue. It really is, it's a consumer issue. And the efforts that we're making to help educate our lawmakers and our regulators really is on a bipartisan scale. But with that being said, it's important that everyone here in this room, and I'll talk a little bit about that, gets involved a little bit, just a little bit, that's all it takes, gets involved with the political process, paying attention and be participating in your PAC. And honestly, quite frankly, everyone here in this room should have a big pat on the back for just being a member of NAR and SABOR and TAR. So, pat on the back for you guys. So, who are we and where did we come from? Real quick, NAMB started out in 1973 as a trade association for mortgage brokers. As the industry has evolved, it's not just for mortgage brokers anymore, but also for mortgage bankers. There is the Mortgage Banker Association that tends to work more or less on a more company-side scale. NAMB really works more or less on a more of a originator type of issue scale. But that being said, we are a nonprofit organization, and we are up there on Capitol Hill constantly fighting for our consumers and their ability to have equal access to affordable credit that's out there. Me, I'm John Hudson. I've been with Premier Nationwide Lending and been working with the same group of people for the last 15 years. We started Premier back in 2002, and we've been having fun doing everything that we can to help our consumers in the state of Texas. We started out, small mortgage operation, and now we're doing over $2 billion a year, and we have fun. We're good at what we do. We're from Texas, privately held. We have fun. So, bottom line is, where do we go from here? And I love this picture because it really does describe what it's like being up there in Washington, D.C. Obviously, you get a great view of the Capitol building, and then you'll see, they actually don't have these road signs, but there might as well be. It's kind of saying good luck there. And this is what it's like to try and navigate, because you really have to know which direction to go, whether it's Republican, whether it's Democrat, whether it's in front of a regulator. You're really going to get hit from all sides on any issue. Unfortunately, that's just the way it works. What I'd like to tell people is, well, first of all, let me ask you, has anyone here been to the NAR lobby days up in Washington, D.C.? All right, a handful. So you guys actually witnessed this. So you know what it's like being up there on Capitol Hill, marching through the halls of Congress. If you haven't done it, for those of you that haven't, I highly advise you to please try and take the time to go up there and do it next year. It's a great time of year. Not only do you have the cherry blossoms blooming, but also it actually feels good to be participating and doing your part in that political process. So, what are we faced with right now today? Well, what we have to deal with is the CFPB. Show of hands here, how many people have heard of the CFPB? How many people can tell me what it stands for? All right. The CFPB, and please, don't be afraid to raise your hand and ask any questions at any time. It's easy to get lost in the alphabet soup that I'll talk about. The CFPB is the Consumer Financial Protection Bureau. They have a broad mandate, that is, they are out there to protect the consumer. I refer to them as the mother of all agencies. because the CFPB, which was, well, I also kind of refer to them as the Dodd-Frankenstein, because they really are a monster, and just in pure depths of their size and their power and their ability to literally have rulemaking authority over every financial transaction that a consumer in this country will make ever. From your checking accounts, to using your ATM debit card, to pay for your gas, to buying a house, to getting a student loan, to financing a car, to your retirement accounts, to what's going on in your 401k. Anything that has to do with consumers and finances, the CFPB has rulemaking authority over that. Why is that important to know? Why are they also part, what I refer to as the mother of all agencies? Because at this time, they're under no House appropriations, which means they really do technically have an unlimited budget. They can borrow from the Federal Reserve Board at any time. And at the same time, they are structured where they really are, there's one director, meaning there's really truly one boss, who really technically doesn't have to answer to anyone in Congress because they're not under appropriations. And this one boss happens to be a political appointee. That should be of concern. So right now, you might have heard in the news some of this about this Director Cordray and how he's been renominated and the Republicans don't like him and the Democrats don't like the Republicans for not liking him. Well, what I can tell you about that is it's not that the Republicans have a problem necessarily with the CFPB. What they want, though, is a different structure. They're saying that, hey, any agency, any regulatory body that's going to have this much power and influence really shouldn't be controlled by one person, by one political appointee, but really it should be controlled by a board, just like the Securities and Exchange Commission works, just like the Federal Reserve Board works, just like any of the other really powerful agencies up there, not just one political appointee. So at any rate, Director Cordray, right now his directorship is in question. If you recall, or you might have heard about this in the news, but the Federal Appeals Court recently ruled that the recess appointments from President Barack Obama to several people to the National Labor Relations Board was deemed unconstitutional. So it just so happens that Director Cordray's appointment to head up the CFPB happened at the same time, the same day, within the same hour as the National Labor Relations Board's appointments. So be expecting to hear a lot of fire about whether or not Director Cordray really is constitutionally there. There are several lawsuits that have been filed, and it's going to take time to trickle through the courts. So some people say, hey, that would just be great if the CFPB went away, because guess what? That way we wouldn't have to deal with any of these rules that are coming out. Well, that's not necessarily true. For all of the faults at the CFPB, they really have done a good job of trying to understand what it is exactly that we do in the mortgage world, and try to come up with rules that are fair to all parties. If the Director Cordray was to be ruled unconstitutional, and then all the rulemaking that the CFPB made over the course of the last 2 years went away, well then we would be stuck with much more draconian rules that are taken straight out of the Dodd-Frank bill. So we really are kind of chasing ourselves down a rabbit hole. So Director Cordray, though, did say what a vibrant economy needs is a vibrant housing market. Who can argue with that? He says that in order to have that, you need 3 things: transparency, free market, and fair competition. Who can argue with that too? That makes sense. However, once you get into what the definitions of fair market, fair competition, and transparency are, that's a little bit concerning to us. And just to give you an example, if I were to be audited by the CFPB, and they came in, they just weren't sure, something might have looked funny with our corporate tax returns, their idea of transparency would say, well, we're not tax people, but we're going to go ahead and refer you over to the IRS and have them come and take a look at this. So their sharing of information amongst other agencies is a little bit of a concern. The other thing in this, I love this quote, or I don't, but it says, the head of the Consumer Financial Protection Bureau said Friday, the only way to create meaningful change in the mortgage market is for citizens to unite with federal agencies, state officials, and local partners. That statement concerns me. Why? Because it kind of promotes an adversarial relationship between a consumer and their mortgage professional when they're attempting to buy a house. It kind of goes out there and says, hey, that mortgage company is probably doing something wrong, So no matter what, you need to be on their back and probably turn them in to have a regulator come in and take a look at it. I mean, not that our jobs are easy enough. Having this adversarial relationship, or the consumer come and apply for the largest financial loan that they're ever going to make, and having this attitude in the back of their mind of, well, where's my gotcha moment? What is the bank trying to do to get me? That is of concern. So what's going on with the CFPB right now? Obviously, we're waiting to see what's going to happen with Director Cordray's appointment. The number 2 guy left, the number 2 guy came in from Massachusetts, who is a friend of the mortgage industry. He's a friend of mortgage brokers and originators, so that's a little bit of a breath of fresh air. But there's some speculation that Cordray might leave and go back and run for the governor of Ohio, where he was a state attorney general and 4-time Jeopardy champion winner. True story. I mean, when I was up there in D.C. and I went to meet him, I really grappled with the thought of, should I ask everything we talk about, put it in the form of a question? And I didn't, but I did tell him, I said, Director Cordray, I embrace you as my new regulator. He did have a funny look on his face. I think he thought I was going to reach up across the table and hug him. But what I was trying to do was just express the point of, I want to work with him as a regulator, not as an enforcer, which is a little bit of a concern when any appointment or a director of a regulating body comes as a background of a state attorney general, where their claims to fame were filing massive lawsuits. So anyway, before I get into the qualified mortgage, just so you guys are aware, there really is so much. There really is so much that is happening in the mortgage world. Who here is starting to see that it's a little bit more difficult for consumers to get loans? Pretty much, yeah, everybody's showing hands are going up. Well, just so you know, every lender that's out there, whether a broker, banker, depository, it really doesn't matter. We really are fearful of the CFPB, the Consumer Financial Protection Bureau. Just so you know, some of their hot points right now, sham joint ventures and marketing services agreements. Interesting case just 2 weeks ago. The CFPB came out and they have slapped an enforcement order against a Dallas area home builder. Not a big builder, small builder. And they fined him $118,000 and gave him a 5-year ban on receiving any type of revenue from any other settlement services. So why is that interesting, you say? 118, 5-year ban. Well, it's interesting because this was a small builder, which shows that the CFPB is not afraid to be looking down at the little guy. As a $2 billion a year mortgage bank, and with anyone that's a mortgage banker or mortgage broker out there, we're all looking at it from the standpoint of it's not a matter of if we're going to get audited, but it's a matter of when. And when the CFPB comes in to audit you, they actually bring their team of enforcement attorneys. So, I mean, how's that for an audit when the auditor shows up and they have a team of attorneys? So now you've got to be afraid of, okay, now I have to get my attorneys to come out, and it just becomes a mess. But anyway, so with the sham joint ventures, now what these guys were doing was blatantly against any type of RESPA rules. There's no doubt about that. But again, it just goes to show that the CFPB is not afraid to look at even the smallest of players. Interestingly enough, this case was actually referred to the CFPB from an FDIC audit of a depository institution that happened to be tied to the builder. So all these agencies are sharing information with each other, and they are enforcing the rules. Misleading advertisements, it's even referred to as the village idiot test. Any advertisement that's out there that the dumbest guy in the city can be potentially misled or confused by falls under a violation of the Federal Trade Commission and CFPB's misleading advertisements rule. And unfortunately, this doesn't just apply to mortgage companies, but this does also apply to real estate companies. I hate to say it, but I see advertisements all the time in all the little real estate books where there are advertisements from real estate professionals that, well, unfortunately cross that little line of, hey, now we're getting into potentially misleading advertisements. And we've all seen the no credit, bad credit, okay, or hey, your mortgage payments are going to be less than what you're paying in rent. That can technically be considered a misleading advertisement. So that's another topic for another class, but just be aware of that, that the CFPB, they are looking at these advertisements out there. It used to just be the UDAP, the Unfair Deceptive Acts and Practices rule, but now I call it UDAP. because they added the word abusive in there without giving us any definition of what abusive is. The legal definitions, or what I've been hearing from several attorneys' opinions, is anything that can be deemed abusive to a consumer is abusive. And I'll sit there going, well, what does that mean? Well, anything where a borrower can be potentially misled or confused or potentially steered is misleading. So, and is abusive. So again, we really don't have a definition of what that is. So it's going to be one of those things that's going to be up to the courts to decide, unfortunately. Compliance controls, you're going to see a lot more people focusing on compliance. And that's because if you have a T that's not crossed or an I that's not dotted, the potential for not only legal liability, but the potential for also having that lender have to buy back that mortgage loan, or having to pay a fine, or potentially having to forgive that debt to a consumer is real. So that's probably why you're starting to see a lot more lenders really cramping down to make sure every T is crossed and every I is dotted. Very, very important stuff. Vendor oversight, this one is very difficult for us as a lender because any third-party vendor that we have in a transaction, we have to make sure that they are in compliance. You say, okay, well that sounds easy enough. Well, stop and think about this. Every credit reporting agency that we pull credit through is considered a third party. As a wholesaler, any mortgage broker that I do business with is considered a third party. Any appraiser, any title company that we do business with is considered a third party. And yes, even under certain legal opinions, a real estate agent in that transaction that we're doing a mortgage loan on is considered a third party. So somewhere, somehow, I as a lender am going to have to certify that you are in full compliance with every law that's out there. How in the heck are we supposed to do that? Very, very difficult to do. So it's going to be fun to see how that shakes out, but yes, these are part of the new rules and regulations that we have to deal with on the mortgage side. Fair lending, this is another really big hot button. Hopefully if I have enough time I can get into a little bit about this, but if not, I highly advise you all to go and Google disparate impact and mortgages. And you will see where what disparate impact is. It's a policy or practice that, while neutral in face, may have a discriminatory impact on consumers. And you stop and go, well, what does that mean? Well, to give you a perfect example, right now the CFPB is currently going after the auto dealers for their financing tactics, or the way that they finance cars, because they're saying it's going to have a disparate impact on consumers. And on the auto dealer's defense, okay, consumer comes in, they have a 500 credit score, which is really, really bad. Give them a loan and say 9%. Another borrower comes in and they have 800 credit scores, which is pretty good. You give them a loan of 2%. Well, as that happens to go through, time after time after time after time, finally there's enough data that's compiled to show that more minorities tend to have lower FICO scores than non-minorities, and therefore these minorities are also being charged higher interest rates than non-minorities, and therefore it's discriminatory and there's a disparate impact on a certain protected class. And you stop and think to yourself, well, wait a minute, that they have bad credit and they're just simply trying to price in for risk. Well, I mean, that's generally the whole problem with this disparate impact. Disparate treatment, lock them up and throw away the keys. Disparate impact, where there's no intention, of any type of discriminatory act or practice. Now, what are you supposed to do? It's literally going to put people in a position of damned if you do or damned if you don't. There's also fear on the mortgage side that if we, let's say, by rule, by some of the things that are coming out, we have to set a minimum loan amount that we'll finance. That's potential liability under disparate impact. And complaints, they do have a pretty interesting new database where every complaint, whether that person is found guilty or not, or whether the complaint is valid or not, is going up on their website. And from what I understand, right now, I mean, it only includes finance people, but they are looking at adding different vendors to that complaint database. So what is the qualified mortgage? And again, this is what you're going to have to be dealing with starting in January of 2014. From the outset, it was created from Dodd-Frank, and from the outset, it's really not a bad idea. Hey, we want to make sure that mortgage companies only offer products or underwriting standards that determine that a borrower can repay that loan. Who can argue with that? It's probably not a bad idea for mortgage companies to make sure that borrowers can actually pay back the mortgage before we give them a loan. It's pretty sad, though, that we had to wait for a law to be written in order for this to be enforced. But it was really there to eliminate risky products, which were your stated income, stated asset, waiving escrows, 120% loan to value to the 500 FICO score borrower, first-time buyer that really has no idea what they're getting themselves into. So it eliminated the risky products. Okay, that's not necessarily too bad. On the downside, though, I will tell you that there were a lot of qualified borrowers that the stated income loan probably wasn't a bad program for. And I'm referring to those self-employed borrowers that have tax returns that are about the size of the law. We as a mortgage company, we don't want to underwrite those tax returns. Those products, basically, they're gone. It set criteria for income and asset documentation. So basically what the CFPB is now telling us as mortgage companies is how we need to underwrite that loan. And probably the biggest potential for problems that I see that definitely have an impact on consumers is this 3% cap on points and fees. It all sounds great from the outset because every press release that comes out there says, we want to make sure that consumers aren't being charged excessive upfront points and fees. Who can argue with that? I love that. Let's make sure that consumers aren't paying too much out of pocket. Well, once you start digging into this 1,100 plus pages and you start to see what the definitions of points and fees are, you can start to see where the industry is concerned and why there's going to be a lot more stuff considered in that 3% cap that's going to have a negative impact on consumers. So why would I not want to originate a non-qualified loan? Is because the risk of non-compliance far exceeds my possible rewards for originating that loan. Not only am I liable to civil remedies, but also paying actual damages. There's special statutory damages such as right off the bat I would have to pay 3 years worth of all the consumer's interest charge or finance charges. So just to give you an example, 30-year fixed, 4% mortgage, $200,000 loan amount, 3 years of interest is $23,000. There are certain violations in the statute that can call for treble damages, which would easily get you up to $69,000 in a hurry. Why as a lender, do I want to take that risk? On top of that, the defendant will have to pay for the plaintiff's attorney's fees, which we've all seen enough of the plaintiff's attorneys throughout the country going out there saying, let's sue your lender, and they are, and we're doing it on contingency, and they're just tying up the legal system. So expect to see more of that. And there's a 3-year statute of limitations right off the bat, meaning that consumer has 3 years to decide whether or not they want to challenge if I actually determine their ability to repay or not. Now, if that consumer, this is hypothetical, of course, but what's not hypothetical is there's no statute of limitations for defensive foreclosure. So the hypothetical scenario is that in year 29 of that 30-year fixed rate mortgage, that borrower loses their job and no longer has the ability to make that mortgage payment. What's going to happen? Lender's going to come in, file foreclosure paperwork. I mean, it stinks, but that's just the way the world works. If you rent a house, if you're a renter and you quit paying rent, landlord gives you 30 days notice and then the sheriff shows up and kicks you out. In this case, 29 years of that, they can no longer make that payment. They can actually they can tie me up in court from foreclosure, make me pay all kinds of fees, let alone attorney's cost, in order to go out there and prove that 29 years ago, I had a loan officer that made sure that borrower had the ability to repay that mortgage loan. So the end result ultimately will probably be that, hey, we determined that they had the ability to make that mortgage payment, and the foreclosure would probably go through, but at a severe expense to the lender and the servicer of that note to have to go through the process in order to get that done. On top of that, there's assigning liabilities to where anyone in the secondary market that I sell that mortgage loan to could potentially fall prey to having to defend that their loan met the qualified mortgage definition. And when I say that, does anyone know who the ultimate holders of mortgage-backed securities are? Everybody in this room. Your 401ks, your insurance companies, your pension funds. Mortgage-backed securities are owned by everybody. So that's going to be interesting to see how that all plays out. So on top of that, I mean, gosh, obviously having to maintain massive amounts of data is very difficult. So what is a qualified mortgage? And again, I hope I'm really not trying to scare anybody or impress anyone. It's tough to get up there and talk about this stuff so early in the morning and have to listen to it and still be able to go on with a smile for the rest of our day. So what is the qualified mortgage? Any consumer purpose loan that is secured by a dwelling. It doesn't matter if it's a purchase transaction, a refi, what we call a Texas A6 cash out mortgage. First and second liens are covered. What's not covered? Home equity lines of credit, timeshares, reverse mortgages, which, in my opinion, if there's one mortgage product that really needs to be reformed, it's the reverse mortgage product. Interim construction loans are not covered, commercial loans, loan modifications. There's some speculation that there's some folks that have asked me, well, what about investment property loans? What if I'm trying to I want to buy an investment property? Well, in that sense, I can pretty much assure you that if you're going to a traditional mortgage bank or a mortgage broker, we're going to consider that. You're still going to have to meet the qualified mortgage definition. If you really want to do a true non-owner and not be a qualified mortgage, you're going to have to go get either hard money financing or some sort of commercial loan from a bank. So what else happens here with the qualified mortgage? This is something that everyone needs to be concerned about. Although there's a 7-year exemption, but home loans will require a maximum back-end ratio of 43%. Now, ultimately, that's really not too bad. Personally, I would love it if every one of my borrowers had a max back-end ratio of 43%. However, the reality of this, the society that we live in today, that's simply not the case. We see a lot of loans that are out there pushing 50%. Certain cases, possibly over 50%, because that's the only way to get them qualified for that mortgage loan today. On top of that, what we don't take into account when we underwrite for home loans is the 3 kids that all have iPhones, the Dirt TV Sunday sports package, they had a few traffic tickets, so they're a really high insurance rate. They eat out a lot, so we don't take those things into account when we underwrite loans. What do we take into account? Minimum monthly revolving and installment debt payments. Minimum payments. So again, with this 43 backing ratio, why is it going to be difficult? Because what I see happening today is a lack of truly affordable housing. And I'm not talking about the first-time home buyer, the $70,000, $80,000 home. I'm talking about, honestly, the median home, that $140,000 price range, where we can get somebody in there for $1,100 a month payment. I mean, when you start driving around town, you see all the new developments and new communities saying, hey, starting from the 300s. That's great. But I don't see enough people for the median income in the city of San Antonio to be going up to meet that track.
That's right.
So what's going to happen 7 years from now when all of a sudden we have to go to this max 43 back-end ratio, and really the only people that have the nice $200,000 to $300,000 houses are the people that can truly afford it. What happens to our low to moderate income consumer? What happens to our first-time home buyer? Not only that, but just couple that with the fact that we have a looming student debt crisis on our hands that's fixing to blow up and make it a heck of a lot harder for us to qualify people for mortgages. We have a real potential problem here. And unfortunately, it's 7 years down the road, but once these trains leave the station, they're very difficult to stop. Safe harbor, if I go through all this, yes, there is a certain protection here. I do have a safe harbor, meaning that I will still have to show up in court, but it would be more likely that the judge would be find in my favor that I originated a qualified mortgage. If I go through these checklists and make sure that my interest rate is 1.5% less than the Federal Reserve Board's APOR, the annual percentage offering rate, or rebuttable presumption if my interest rate is higher, which rebuttable presumption means while it's presumed that you determine that that borrower can repay that mortgage loan, I can still rebut it and challenge you in court. And of course, here we get into the 3% cap on points and fees, which is also going to be problematic. So with the underwriting guidelines that the CFPB gave us, and again, now we've got a bunch of folks up here in Washington, D.C. telling seasoned mortgage veterans how to underwrite a loan, which is kind of ironic to a certain degree, considering a lot of the folks that I met up there at the CFPB were younger than I am, and just graduated from a Ivy League law school, and hadn't bought a house yet. So, but anyway, what did they give us? The CFPB gave us, basically they copied FHA's underwriting guidelines, which we commonly refer to as the HUD 4155. However, one thing to really notate here is that they took out the language that's in there for underwriters to view and accept compensating factors on mortgage loans. So for example, there are certain cases where with that FHA loan where, you know what, those borrowers, they had a really, really tough time a few years ago, and that's why their credit has some issues. But look, they've made efforts, and they had extenuating circumstances like either a death in the family or something along those lines, a real life event happened to them. So, but they've gotten themselves together. So we're going to go through, and we're going to go ahead and actually we're going to use compensating factors to make this mortgage loan work. Well, unfortunately, with the new rules that are coming out, we're losing that ability to where, okay, we are going to get something black and white, and it's going to be, here are the guidelines that you must follow. I don't want to get into too much of the details here just for time's sake, but what I will tell you, well, two things. One, everyone's going to get a copy of this presentation, so that way you guys can go back and references. But I do just want to point out a couple things, and I love this first one up here. Income can only be used if it comes from a source that can be verified as stable and will continue. Income must be reasonably expected to continue for at least the first 3 years of that mortgage. Has anyone ever tried to call a human resources department and get them to guarantee that that borrower is going to have their job 3 years from now? Extremely difficult to do. Let alone, how can we predict what, let's say that they have bonus income. We have a very hard time. Hey, they've been making bonuses for the last 5 years. Hey, can you just put down that they're going to get a bonus this year? No, it's not guaranteed. Now I can't use it to qualify for that loan. What about overtime? They've been making all this overtime, blah, 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 blah. Can you guarantee it's going to continue? No. Oh, all right, great. Now I just lost that ability to use that to help these borrowers qualify for a mortgage loan. So you can kind of see where I'm going with this, and that is that underwriting guidelines, which are going to be set by the government now, are basically saying that, hey, this is going to be the rule. Very difficult to do. So we couple that with home prices are rising, borrowers' incomes are steady, and now it's going to be tougher for me to underwrite and qualify people for mortgage loans. What does that mean that's going to have to happen? Home prices are going to have to come back down, right? There's going to be a downward pressure, again, back on home prices to get people back into this affordable range. So we've got a real catch-22 on our hands. So anyway, so this is part of some of the underwriting guidelines. Again, I'm going to make sure that you guys get this. But again, the bottom line is ultimately that, hey, your debt to income based on the gross monthly income cannot exceed 43% back-end ratio. So, I mean, this is just the world that we're going to have to live in. Oh, and just by the way, I have to include any mortgage-related obligations or simultaneous loans at the time of consummation of that loan. So when your mortgage professional tells you to make sure that the borrowers don't go to Best Buy or Lax Furniture prior to closing on their loan, please don't let them do it. We've seen too many times where borrowers say, yeah, and, they have to sign notice that they haven't had any new debt before they close. And they say, well, but we did. And then we go through, and then we calculate the new debt payment of what they just did, and now they don't qualify for the loan. I've seen that happen. It's not fun for anybody in that transaction. So, points and fees, again, yeah, the main thing is 3% cap. If you have a lower loan amount, you get a little bit of wiggle room in there, but for the bottom line is hard cap, 3% of points and fees. Known at or before consummation. Now, what's not included in that would be your FHA mortgage insurance premium, the VA funding fee, a USDA funding fee. Monthly private mortgage insurance payments are not included. What is included is upfront private mortgage insurance, which is problematic because as FHA continues to price themselves out of the market, conventional loan programs really are making a much stronger comeback. And there are borrowers that are savvy enough, or they've worked with their real estate professionals to really negotiate to get that seller to pay some extra closing costs, to where, they just much rather pay that upfront mortgage insurance premium, not have a monthly mortgage insurance premium. Well, now that's going to be included in this 3% cap. So the MI companies are pretty concerned that that product's going to be going away. I'm concerned that that product's going to be going away. Affiliated title fees. affiliated fees in general. Does anyone here work for a company under any circumstance, the umbrella, that has an affiliation with either a mortgage company or an affiliation with a title company? So, in that transaction, if you have a direct affiliation, and of course the definition here is under the Controlled Bank Act of 1956, but if you do have that affiliation, then that title policy is now going to be included in that 3% cap on points and fees. So yeah, you heard that right. So is anyone from D.R. Horton here? I'm going to pick on D.R. Horton. So if I'm a borrower, and they're easy to pick on because they got the mortgage, the title, and they're the home builder, right? So they've got all three in there. If I'm a buyer and I want to buy a D.R. Horton home, and they say, oh great, we'll use our mortgage company over here, and you're going to use our title company over here. Well, now all of a sudden, any fees that the mortgage company charges me are included in that 3% cap. And on top of that, the title company fees are included in that 3% cap, which means that, shoot, now the minimum loan amount that I'm really going to be able to get is going to be around $250,000 if all that stuff has to be included. Well, I don't want to buy a $250,000 house. Oh, but if I go and use a title company down the street, then regardless whether or not they may be charging me any more or less, that title policy is not going to be included in that 3%, and now the loan's going to pass. I mean, tell me where that makes sense. Unfortunately, when they get into what's happening, what they're doing with the mortgage companies, which the CFPB just last week decided that we are not going to have to include what I pay on the retail side, what I pay my loan officers, in that 3% cap on points and fees. They also said that mortgage brokers do not have to include what they pay their loan officers in that 3% cap on points and fees. Trust me, it was very close to that being included too. However, what they did include was the mortgage broker entity compensation, which, and I don't want to get into too much of the details, again, that's another topic, but basically as a wholesaler, I pay the mortgage company, the mortgage broker company. And that mortgage broker cannot charge any other fees in that model. Well, the mortgage broker entity compensation is included, but not what they pay their LO. So it's very likely that we're going to have instances where we have two identical loans, same interest rate, same cash to close, same monthly payments, same everything. And they're going to get down to only the manner in which that loan funds is going to be the determining factor of whether or not I have a qualified mortgage. Which, by the way, the qualified mortgage, the whole purpose of this is to make sure that I've determined a borrower's ability to repay that loan. So you would hope that I would have already determined that borrower's ability to repay that loan by the time I sent docs to title, right? So you can see where there's definitely, the playing field is not level. And where does that hurt consumers? Well, obviously, when a mortgage broker is, if one whole side of the industry is wiped out, we have less competition out there. Which, can anyone remember the last time that less competition was good for consumers? I can't. Non-qualified mortgage loans, the ability to go out there and originate non-qualified mortgages will still be there. And in fact, just so you know, the CFPB did also give certain exemptions to certain creditors, certain in small rural areas. They gave certain exemptions to certain nonprofit agencies. And the problem that I see there, and this is what I submitted in my public comment, is the fact that we even have to give exemptions to the own rules that they're creating here should be a sign that their whole system is flawed. So anyway, yeah, I mean, there's still, the possibility of being able to go out there and originate a non-qualified mortgage loan. If I wanted to take the risk of having to show up in court every other day, then I can go out there and do that, just so long as I can show that I did 8 things to determine the borrower had an ability to repay that mortgage loans. But do I really want to be known as the guy that's originating non-qualified mortgages? Can you imagine? Okay, I mean, if I had a loan officer, or let's say I was a loan officer. If I was a loan officer, what would y'all think if I was out there calling on realtors saying, hey, I'm the guy that originates non-qualified mortgages. Send your borrowers to me. I instantly think, what is he talking about? I don't want to deal with anyone doing non-qualified mortgages. That just doesn't sound good. So you obviously have some reputational risks. There's some legal risks. How are those going to be mitigated? I mean, are I mean, are we truly going to get to a point to where closings and as well as loan applications are going to have to be videotaped like there's some deposition? I mean, can you imagine that if you were at a title company and you had the lender there with a video camera saying, hey, borrower, I'm sorry, can you scoot over a little more to the right? I need to make sure your face is in here. So that way when you're signing these documents, I could ask you if you understand every single document that you're signing. Has anyone read everything that they sign in closing? Only a couple, right? It was funny, the previous number two guy at the CFPB, he even admitted that when he refinanced his loan, he didn't read everything. He was like, there's so much paperwork, I didn't read everything. And I'm sitting there going, you're the number two. You're the one making up all these stuff. Why? I mean, honestly, our closing packages should really just be one page that say if you don't pay, you don't stay. We don't need 900 pages. So anyway, are we going to get to a point where if you're, taking the running that risk of doing a non-QM loan, that you're going to have to videotape it? Possibly. And then what's worse on that is, okay, if I am going to assume all these risks that are involved and the potential for litigation, I'm going to want to do what? Price in for that risk, right? I mean, I'm going to make sure, why would I take that risk for 3% over 30 years? Well, the problem though with that is, again, you run into certain Homeowner Equal Protection Act triggers, Section 32 of RESPA, high-cost mortgage loans. So now what have I done? So now I can't even price in for the risk of originating this mortgage loan. So very, very difficult to navigate around. So what have we done about it? I actually got the great opportunity, to testify in front of Congress last year. It was truly an amazing experience. A little bit nerve-wracking, but at the same time, once I kind of got into gear and realized that I knew more about this stuff than the people asking me questions on it, I got in a little bit of a role. So it was a great opportunity though, but I was there advocating for consumers, particularly the people that are in my neck of the woods, which are Central and South Texas, which, hey, let's face it, my median FICO score, my median sales price, my median income is lower than that of the rest of the country. It just is. That's where I live. Those are the folks that I want to represent. Those are the folks that I want to make sure that that everybody has the opportunity to participate in home ownership in this country. Not to say that I'm just reading anything off the NAR tagline, but I truly believe, just like I'm sure everyone else in this room does, that home ownership is the greatest tool for wealth generation in this country. And I'm not talking about Flip This House, because we all should have known the world was coming to an end when Flip This House was a top-rated TV show. But I'm talking about transgenerational wealth creation through home ownership. Mom, dad live in a house, eventually they pass on, they leave an asset to their heirs have the ability to do whatever they want with that, but really, move up. Home ownership is a way to help that low to moderate income consumer move up in the world. So, if we lose that ability, then what are we doing? We're creating a permanent class of renters, which I believe is absolutely unfair across the board. So, where are we? What can we do to help solve some of the potential pitfalls? The big push right now is House Bill 1077, which is the Consumer Mortgage Choice Act. We have been working very closely with your representatives at the national level from the National Association of Realtors. We've been working very closely with the Mortgage Bankers Association and home builders to really get this bill correct, or to get this rule correct. What we're trying to do here is amend Truth in Lending, which would open up that 3% cap on points and fees. Basically what I'm trying to do is make sure that affiliated title fees are not included in that, and making sure that, clarifying that escrow charges could not be included in that definition of points and fees. Because let me tell you, per Dodd-Frank, per Section 1403 of Dodd-Frank, yes, escrow charges could be considered a point and fee to be included in that 3% cap. Fortunately, the CFPB recognized that was a problem and they took it out. But I'm sorry, but I want that in law, I want that in writing, that would never be included in there. Also, this will remove loan level price adjustments, which Fannie Mae, Freddie Mac hit consumers with, depending on their FICO score and how much money they're putting down. Those adjustments are to be included in the 3% cap. This bill would also remove any salaries, any compensation that I pay my employees, and also any lender-paid compensation to mortgage brokers. So what you have in front of you is talking points, joint talking points from NAMB, NBA, NAR, Respro, to please pick up the phone and call your congressman and tell them that, you know what, they need to support HR 1077 because it's the right thing for consumers. It's the right thing for borrowers to have that ability to have equal and affordable access to credit that's out there. So I'm going to go through just kind of a quick little lightning round here, super fast, just to give you some ideas of the other things that we're having to deal with out there. The qualified residential mortgage, that's still on the table, that's still coming out. Probably won't see that for the next year or so. However, this one has the potential to call for a 20% down payment. Imagine how well that's going to go over. Just to give you an idea, in 2009, after the crash, when lenders actually decided that we were going to make sure borrowers would repay loans, only 30% of all home loans would have passed the definition that's proposed under the QRM. So I like to turn around and use the talking point of imagine what the auto industry would look like if they lost their ability to finance 70% of their products. Now, I know as real estate professionals, we all love it when we get that cash buyer. Let's face it, those are far and few between. So imagine what's going to happen when we lose the ability to finance a lot of home loans. Appraisals. Who here has had an issue with an appraisal? Yes, there are efforts that are being out there right now to help resolve some of the appraisal issues that we face. Probably the most common and the one that's most annoying for me is when we have to call you guys and say, sorry, the value just didn't come in. This 1,800 square foot house just isn't worth what you're saying it is. And then you have to say, 1,800 square feet, where the hell did you get that baloney? It's 2,000 square feet. And then we have to go through this whole long process to get the appraiser to go back out there and remeasure. And even though he's wrong, we've now had to extend that borrower's lock and either charge the consumer or absorb those costs. And by the way, now we're also out of contract. So now the sellers are also out of contract because they were going to buy a house, and then it just goes on and on and on. And by the way, I'm sure there was a moving van parked with a title company somewhere in that transaction. LO compensation, you guys really don't need to know about that. Integrated mortgage disclosures. Yes, even though we all are just now finally getting used to the new good faith estimate and the HUD-1 settlement statement, those are going away and changing next year. The main thing that you guys need to be aware of, and by the way, the new ones I really do like. They actually show what the borrower's total monthly payment is. They actually show what the interest rate is, what the cash to close is, including the seller contributions. What I don't like, what I am fearful, and this is in the 1,600-page reg, this is a 3-day waiting period for purchase transactions. You heard that right. So we close on Monday, not going to be able to get the borrower keys until Friday. So now imagine if somewhere in there, something happens where I have to extend a lock, and now I have to redisclose, and now I have to redraw docs. So now that Monday closing just became a Wednesday closing, and now that Friday funding just became a Monday funding, and now again, somewhere there's a moving truck parked at the title company trying to figure out where the hell they're supposed to go for the weekend. So you can see why this would be problematic. Again, this is going to be important to work with and support your trade association in NAR because they are working very hard to get that fixed. FHA, they're going to be going to 6 to 3% sometime soon. Fair lending enforcement, again, something you guys really need to be paying attention to. Trust me, Google disparate impact, you'll see what some of the issues are. Where do we go from here in the economy? Honestly, who knows, but I am thankful that I live here in Texas. Obviously, we've been able to weather most of the storm. We never had a massive price appreciation or depreciation. We've just kind of been trekking along, which makes us pretty good. I can tell you that elsewhere in the country, it's still a heavily refi market. So no matter what you read in the national news, just think about how happy and lucky and fortunate we are to live here in Texas. Side note, just to let y'all know, mortgage rates are continuing to skyrocket. And I say skyrocket, it's like, okay, now they're hovering around 4%. So, to kind of put that in perspective, it's still a historical low, but any type of shock, the fact that we went from like 3.25% to 4% in less than 2 weeks, that is a little bit of a sticker shock. Just be aware that mortgage rates are rising. So anyway, where do we go from here? Again, thank you guys so much for supporting NAR, TIR, SABOR, belonging to your trade association. What I do ask is that I don't care what mortgage company you use, love it if you used us, but I don't care what mortgage company you use, just ask that originator, just ask them to make sure that they support their trade association. Whether it's Mortgage Bankers Association or whether it is NAB, the Association of Mortgage Professionals. Why? Because right now, all of our industries are working very hard together to, again, work on these consumer issues. Respond to your calls to action. I know a lot of us, we're busy when we get bombarded with the calls to action, but they literally take 5 minutes. And I gotta say that I don't know anyone that's too busy for 5 minutes to try and do something to protect their livelihood, even if that just means picking up the phone, calling their congressman, calling their congressman's office and say, hey, Mr. Congressman, I need you to get on board with HR 1077. When they say, why? And I say, well, because if you don't, then there's going to be a lot of consumers that are going to be forced into a permanent class of renter because they will no longer have equal and affordable access to credit. So anyway, support your trade organizations. I can't express how important it is. It really is your future. And I mean, I can get up there and rant and rave about that forever and ever, but give your volunteers that are working very hard for you at SABOR a big round of applause, because it is a thankless position. Sorry, it is thankless. And it's a lot of hard work, but it is that these volunteers care about this industry, this profession, your livelihood. And so, you know what, help them out, volunteer, get involved, get on a strategic planning task force, do what you can, do your part. And despite the regulation that's coming out, we're always going to be needed, we're always going to be around, we will survive, we will adapt. So thank you very much. That's kind of it in a nutshell. There's a lot more that can be said and get into some of the details. If you have any questions whatsoever, my email is always open. So you can always reach me. It doesn't matter, but I will respond. I will get back with you. We are here to help. Yes, ma'am.
I just have a comment, and that is because the escrow accounts are not really in writing right now, the full definition of them. I mean, in Texas, since we're at 3% property taxes come September, that could.
No, it's in Dodd-Frank, there's the gray area there. In the CFPB regulation, that they are taken out. Escrows are not in there.
So the law that comes in January, that is.
Yeah, escrows are not included.
They will be.
They will not be included in that 3%. What this law does, though, is it codifies that.
HR, 1077 takes care of it and covers it. Okay.
Right. It says it'll never come back. Yes, sir.
Hey, John, could you repeat the question?
I'm sorry. The question was, this 3% with the escrows, could it still be included because it's not really in writing in that 3% definition? And the answer is, it's in Dodd-Frank is the gray area. In the rule, in this qualified mortgage definition from the CFPB, it is not in there. So we don't have to worry about 3% included in the capital points and fees right now. But again, we want it as part of this bill to make sure it never has the possibility of coming back. Yes, ma'am.
In regard to HR 1077, are there any of our South Texas representatives co-sponsoring that bill, so that if we were to call and say, hey, we really want you to vote for this, it would be nice to know if any of them co-sponsored the bill, and we could say thank you.
Unfortunately, not at this time.
Okay, so we should encourage them also to co-sponsor.
They need to co-sponsor.
They can sign on anytime.
And I even have a dear colleague letter that I will make sure that gets out to you guys. So that way you can forward your congressman and say, hey, dear colleague, sign on to this bill. So I can make sure that you guys get that.
Thank you.
Yes, ma'am.
Since you mentioned D.R. Horton, I'm just thinking about the different builders here, like KB and D.R. Horton, that they service the whole thing. How is that really benefiting the consumer or not benefiting the consumer?
The question out there is, okay, well, you picked on D.R. Horton, but what about all the builders that have, they've got the whole package? I mean, how is that benefiting the consumer? And it's kind of a difficult kind of catch-22 answer, because while at the same time, yes, I trust me, I think it stinks when my mortgage guys have to compete against, the builder. They kind of have that captured business in there, right? At the end of the day, it still is the buyer's choice. And, if there's a mechanism for that borrower to get a better deal than what I can offer, then they can do that. As part of RESPA, there is no required use provision, meaning that home builder cannot force that borrower to use any particular mortgage or title company. However, we all know that it works. I mean, the odds that a borrower goes outside of there, it really isn't. You know, it's kind of difficult to say, and that's just one instance, you know, here with the local builders. A good friend of mine works for a mortgage broker company that is owned by a large real estate firm that also happens to own their own title company. And in part of doing all of this research for this bill, he actually went through his HUD ones. I mean, yeah, he did not have fun. He spent 3 weeks literally in front of his computer creating a spreadsheet with his HUD ones, and he was going through, and he was able to show that the transactions that where the consumers used their title company actually were cheaper than the ones that were outside. So, you know, do we like it that they kind of have that captured business? No, I mean no, not really. But you know, are there benefits to a consumer? Yeah, I think in certain cases there are. And it shouldn't be the right of the government either to tell businesses how they can or cannot operate.
Okay, but they're still under the same rules as everyone else.
Absolutely, they are under the same rules as everyone else.
We have time for one more question, if anybody else has a question for John.
One more? Okay, well, if not, don't forget, you guys have my email address. Please feel free to email me, and we will make sure that you guys get a copy of this presentation. And like I said, just, you know, thank your volunteers that are working for SABOR and TIR and NAR, and do your part. Pick up the phone. It takes 5 minutes. Support this bill. Thank you, guys.